Hi, good afternoon, everyone. Hope you had a good lunch, had a good break. Thanks for joining us in the afternoon session. So today I will be speaking about technology. I think something that is very dear to everyone at present moment. Why not, right? The sector's done so well. It's such an important part of our lives. Just let me go through a little bit from the start. Recap it where we were at the start of 2024. So we started the year with a lot of things to be worried about, to be thinking about. More than half of the world, the population was supposed to head to elections. We got through most of that, including the most important one in the US. We were in the midst of a number of wars, small and medium, some of which have yet to be resolved. We're seeing some volatility in markets, right, in the Japanese yen, in interest rates. We were concerned as well about the Chinese economy, right? We already hit the 5%. And yesterday's announcement on Friday actually showed they met GDP numbers. There was mixed US economic data, some good, some a little bit less good. There was concerns about inflation, right? Whether inflation would eventually come down. We can largely say most of this has come down quite under control, while we see bouts of volatility here and there. And of course, closer to heart for a lot of us, currency and interest rates, right? How would that affect our day-to-day lives, our mortgages and the likes? Well, we went through all of that safely, all in one piece, and we're here today. And so did markets. So here's a recap of how markets did in 2024. The left half of the slide behind me by region, right by equity sector. So you notice that it was a good year, broadly speaking, right? By regions, was led a lot by the US, by NASDAQ, which just seemed quite a proxy for technology in the US. On the right, by sectors, it is IT, very clearly the leader there, communication services, and consumer discretionary, all of which has quite a bit of tech representation. So I guess the very common question you might ask is, given that tech has done its 20, 30%, 2 years in a row, where do we go from here, right? Is it worth investing? Well, I would look at this chart first as a starting point. So the charts here, the darkest line on top represents Magnificent Seven. I guess that's quite the buzzword these days. The 7 largest tech-related mega capitalization stocks in the US. They have done exceptionally well since the kind of global equity market began in late 2022. Then that actually drove a big part of the market, right? That drove the whole tech market, so that's the second line you see here. But I'd argue that the tech market was a lot driven by Mag stocks by the US. So the line after that strips out the impact of this Magnificent Seven stocks in the US. And you see the rest of the tech market hasn't gone anywhere as far. And in our mind, there is room for catch-up, and that's where the opportunity is. Allow me to elaborate a bit more. So we spoke about performances. Now let's talk about how investors are crowded. Where have they been putting their money in? A good representation is the chart here. So how do you represent all these bars? Each bar represents the percentage of stocks that beat the market every calendar year. And in the last 2 years, 26% in 2023, 26% beat the market. In 2024, a mere increase to 28% of stocks beating the market. This is a very rare occurrence, and you need to go to just before the tech bubble in the very end of the 90s to see that. Over the long term, this is a lot closer and a healthy level of 45 to 50%. That suggests there is a lot more room for breadth to move out, even in the tech space, beyond the Mag 7. And in our minds, 2025 might be the year where you start to see this breadth widen, right? So first, we spoke about potential for investor concentration to widen. The other part is earnings, right? So as we know, stocks are driven, largely speaking, by 2 things, valuations and earnings. So earnings since the rally began in late 2022, early 23, has been driven a lot by Mag 7, the 7 largest stocks in the US, especially after generative AI's theme came to the fore in a year to 2 ago. And this, in many kind of analysts' eyes, the baton of driving earnings for Mag 7 from 20 to 40% is likely to pass on to the rest of the market. So earnings on Mag 7, as you see here in the chart in the red, is supposed, the bars in red, supposed to roll down, to slow down to something like a mid-teens level, while the rest of the market growth, earnings growth, is supposed to accelerate and catch up and exceed at some point. So from our perspective, we are looking at the rest of the market that's cheaper than the Mag 7. Earnings is accelerating while Mac 7 is slowing. To us, that is where the opportunity is. And here, the other place that where earnings, or rather the catch-up trade could be, is in small mid caps. So in the chart before you on the left, it just plots how markets tend to do after first rate cuts, which again is a couple of months ago. It is likely to continue at least in the first half of this year. And on the right, more importantly, while markets tend to do well, you observe small caps, mid caps tend to do better. So that again to us is where the opportunity, and this is a long data set that stretches through to the 1950s, right? So based on history, there's quite a bit of room after rate cuts for small mid caps to catch up. Valuation, so I'll return back to one of my favorite topic, valuations again. So a busy chart before you, right? It plots valuations of different sectors. So here you do see very clearly the US, the tech market, yes, valuations have increased. It's led a lot by the US, that will be the black line, the one right on top. And if I equalize the weights for every single stock in the US, in other words, Mac 7 do not have that outsized impact on the market as they do now, right? The top 10 stocks in the US make up more than 30% of concentration. We just equalize that. In fact, you do see the rest of the US market isn't as expensive as it looks. Valuations haven't increased much since the rally started. That's one point. The second point, if I stripped out US from this entire equation, the rest of the tech market hasn't moved anywhere much as well, even less so. And if I looked at China, right, at the very bright blue line at the end, it in fact has seen valuation come down, right? So my point here is the tech sector, very global in nature, right? It matters slightly less whether you're in the US, Europe, or in Asia because the dynamics are the same. But in the US, you are getting a stock typically for 10 times in valuation more expensive for the rest of the world. So we want to be picking stocks a bit more outside of the US. And in China, right, dynamics are changing. Policies are getting a lot more supportive, right? The Chinese government wants to be self-reliant, and the tech champions are an important part of that. The tech champions have also cleaned up their acts a little bit, removed some of their monopolistic behavior, has fallen kind of a bit more in line, so we find that they will get increasingly more support, right? So again, the message here, if I could summarize what I spoke over the last few minutes, look outside the US, look outside where it's expensive, and US Mac 7, that's a big part of this, and look outside where it's been very concentrated. Just broaden your exposure, even looking at tech. Mac 7, right, everybody's favorite topic. Now, to be clear, we are not negative on the fundamentals of Mac 7 at Fidelity and at UOB, but rather we are just very selective based on valuations. Certain areas, like Alphabet, Amazon, a big part of the entire cloud data center ecosystem, where we like the opportunity set there. That's quite exciting to us at present moment. Other areas, a bit more expensive. Meta, a bit pricier, a lot of regulatory headwinds in place, we're a bit more careful. Nvidia, the current darling. We feel markets are very optimistic on the outlook for this particular stock alone. So we want to be careful. We find there's the risk reward isn't favorable. We prefer to look across the value chain, the AI value chain, to find our spots. Other areas like Netflix, it's exciting but expensive. Apple, Microsoft, the same, right? Valuation keeps us a bit more careful in some of these areas. So where are we looking at in the tech space, right? So I spoke about a bit outside the US, a bit outside Mac 7, look where it's cheaper, where markets are underpricing. These are some of the themes that we are looking at in our transformation strategy. And I'll go through some of that in some detail in the next couple of minutes. First, AI, right? I guess no tech conversation this day can go past without talking about the AI. So I guess when looking at AI, we apply a bit of a simplistic view to make some sense of changes. So it's very much akin, if you remember, to the 90s, 2000s, the internet, mobile device era, right? There were actually 3 phases to it as well. The first phase, when internet as a concept came about, and potentially having internet in your hands and your devices came about, the first area that made the most sense was semiconductors. Second sense, when semiconductors get a bit more advanced, we started to think about infrastructure. Hence, the Apples, the Samsung handsets came to the fore. Right? And as things develop, technology tends to build and evolve on itself. Phase 3 came about. And there came about all the software we have today, ranging from your Facebooks, Instagrams, your Grabs, and the like. So we apply this same train of thoughts to this AI did today. So we are likely very much to be in phase one, where semiconductor was the early trade, everyone was starting to place orders, it's done well. This at some point should slow down a little bit. Then demand should move more to data center to cloud, right? With all the data produced, it has to be stored somewhere. And we feel that's probably the late stage of one, and we're probably somewhere close to that. Phase two, there's already some chatter of AI-ready smartphones and PCs, and we feel demand will start to flow in this area. 3 and 4 is a bit more gray now, as we did in the PC handset era. There are some software names that potentially can be beneficiaries. We're also starting to find some good kind of positions in this area. But largely speaking, we're probably in phase 1-ish, 2 at present moment. And when you look across the AI chain, it's a bit more than just NVIDIA, to be honest, right? So if you look from a semiconductor perspective, there are many options from designer to semi-equipment makers, through to memory names, to a fab company like TSMC. One should be a bit more selective here, right? Where we find in the semi space, it's a bit more interesting, are in areas, for example, like TSMC. NVIDIA's orders, a lot of them flows to TSMC, but it trades nowhere near NVIDIA. Or in other names, memory, like someone like Samsung does memory, but the demand, the fate's very close to generative AI, but valuations are not suggesting a very optimistic scenario. We like areas like that. Down the value chain, cloud, data center, they tend to benefit. So there are good opportunities there as well. Further down the line, there are good opportunities as well in data analytics companies, right? Generative AI needs good data to be fed in to produce good models at the end. Data analytics companies do that job for corporations. Or even IT consulting companies, right? They prepare the workforce, the general corporation for an AI world. That are good opportunities. So I hope in the last few seconds you got the point. I mean, what I wanted to express, that AI is broad, it's just not in NVIDIA and very popular names, and that's how we're positioning the global transformation strategy. So I spoke to a little bit some of the enablers that are less spoken about. So IT services data company, they help clean data. They help move kind of data to cloud-based repositories, for example. Analytics, prepare corporations ready for generative AI world. Not pricing in Outlook, that's an area we like within the AI subspace. Or even data centers, right? More data. There's more need for example, IoT, 5G, streaming, edge computing, fast data, right? Or even increase data recovery, disaster recovery services. Data center needs will increase, and the need for connectivity across data center will increase. So there are names that kind of help facilitate this in the value chain, also not widely spoken about. So we're looking out of the box to think about what's available. When we talk about a trend, a new change, we always like to think about the winners. But on the flip side, there are some losers. Sometimes they turn out to be losers, sometimes they are misunderstood losers. So in our minds, one misunderstood loser, which the sell-off created an opportunity, is software. For good reason. So for corporations, usually every year you have a big IT budget, call it one silver bullet. You fire it at one spot you feel gives you the strategic advantage. So when AI came about, corporates spent it on AI related. They took it, where does it come from? Software and other related spending. So markets were selling off a lot of these software names, right? They expected budgets to go to AI instead of software. But if you think about it, once generative AI kind of grows, it becomes more efficient, there must be a way to express or use AI to produce an outcome, a service, an efficiency tool, right? And software is it. At some point, we feel that demand will flow back to IT. They will need to improve IT and buy more systems, etc. So IT, software, is a sector that can potentially win over the long term. Markets haven't understood it as well, so we are finding good opportunities here. A perceived AI loser, right? So change it a little bit. Another theme we're looking at is a bit more from a market capitalizations perspective, small mid caps. So small mid caps over the long term, many companies started small, right? Like Netflix started really small as a video kind of dispensing or kind of machine, right? They allow people to borrow videos out of dispensing machine, going to a behemoth today. So they can be winners of tomorrow. That's one long-term trend. But in the short term, there is also room for M&A, mergers and acquisitions to grow, right? A new US administration, business-friendly, could encourage some M&A. Big, large caps getting expensive on their valuations. They could issue shares to acquire small mid-caps, grow their businesses. Or PE, private equity firms. Many have the mandate to buy tech firms, a tech mandate. They could be acquirers. So we find M&A could potentially spur in the next couple of years, and that's one opportunity as well. Besides that, we talk a lot about digitization in our day-to-day, right? But actually in traditional sectors, especially in the current world, right, where we want to diversify supply chains, bring back stuff back onshore, away from the geopolitical headlines, tech is a very important part of this digitization, right? At the same time, when the cost of labor of hiring one person in emerging countries like China, for example, has gotten a lot more expensive, and tech's a big solution of this. So digitization of old economy, traditional areas like construction, like manufacturing, that is a trend that should accelerate and stay, and that's the theme one can find within the technological space as well. The other space is of other existing sectors, something we forgot for a long time, music. So I was born in the late 80s, right, mid-80s rather. Music, right, back then we used to buy a CD I come from Singapore, we used to spend $20 on just one CD. These days it's streaming, right? So a lot of these music players have yet to monetize as they did back in the 90s and 2000s. We find tech will allow them to proliferate their music a lot more, monetize it a bit more, and gain scale, right? So we are also expressing some of these tech views through some of the music-related names, right? Thinking out of the box a little bit. Gaming, e-gaming, I guess most of us would have children, or we are kind of young adults at heart, right? Gaming. Gaming has multi-pronged kind of characteristics to it as well. In a slowdown, in a recession, which we might enter in the next 2 to 3 years, who knows? Gaming tends to have a defensive characteristics. When things slow, we stay at home, we game, watch video, they benefit. Over the long term, AI allows for more creative, exciting games. There's more opportunities to be had. Maybe we couldn't have just based on human imagination alone. There's more room for monetization, right? Think about you or maybe your child asking you for money for your credit card to buy skins, add-ons in the games, right? Multiplayer. There's a lot more room for that to happen, and we find gaming a long-term structural trend. That's another tech theme to think about. Or even in simple areas like food delivery, transportation, right? These sectors are still growing, right? The use of Grab, food delivery, etc. is rising. At the same time, on the other end, sectors are consolidating. Many ride-hailing, food delivery sectors are now left with 1 to 2 players. They get a bit of the monopolistic money share by nature, right? They are starting to sell you subscriptions, right? Will allow you to order more at a lower cost, etc. Recurring income, higher margins. That is happening as well. So that's one particular area we like in certain areas like kind of food delivery, etc. globally. China, I guess that is something everyone's talking about. Valuations, we spoke about a couple of minutes from valuation chart. Valuations have compressed a lot since the crackdown started in 2021. Well, I guess in finance, we hate to say this time is different, but it does seem that the Chinese government has very clearly shifted from a clampdown, restrictive mode to something a lot more supportive. And the tech sector is one of the clear beneficiaries. And there are a couple of reasons for that, right? One, to be more self-reliant, less reliant on the outside world for good reason. Second, they want to maintain their national champions to be the flag bearers of China, right? And three, a lot of these companies clean up their acts, right? Not long ago, for platforms, they had a choose-one partner kind of approach. You partner with me, don't work with the next guy. Now that's not allowed. They have to allow people to compete, right? And they've been treating their employees a lot better. They've been paying dividends. That's pretty friendly, and that's what the government kind of likes as well. So tech, we feel they should get a lot of support. Valuations are not reflecting this more positive outcome. And from a fundamental perspective, you see the chart on the top, the bar charts on the top right. Shareholder yield, dividends, buybacks have increased a lot, and all these are very shareholder-friendly actions, right? So putting this all together, risk-reward is looking quite attractive. So in our transformation strategy, we're also thinking a bit harder about China. We're also kind of adding a bit some exposure there as well. So I know I've gone through a lot of different themes in the last about 15 minutes or so, talking about AI, talking about digitization, talking about China, talking about music, etc. Right? So the point I hope you got from me over the last 15 minutes is, one, tech is not expensive if you know where to look. Look at the US, look at the Magnificent Seven. Yes, one can argue they are at the top end of their valuation ranges. Strip out these parts, the rest of market, I argue, valuations are a lot less demanding. And this is happening at a time when earnings of the tech sector still expected to go 20% by our analysts in 2025, and within which Mag 7 will slow, non-Mag 7 will catch up, right? So the opportunity lies outside the US, outside Mag 7. Beyond that, there are a lot of themes, right? AI is very important, but do look outside AI into all the different themes I described a few minutes ago. Those are opportunities that maybe many investors are not fully invested in or thinking hard enough. Valuations still look attractive to us, right? So with that, I hope I left you with something to think about, looking beyond the box, beyond what is obvious, and just pop by the booth and happy to have a conversation with you in a few minutes. Thank you very much. Thanks for your attention. Have a good event ahead.